I have heard most traders say that calmness comes after confidence, that once they understand the market better, once they make more money, once they figure it out, calmness will arrive naturally. It doesn't. Calmness in trading is not a reward. It's a byproduct of rules. And not many rules, just the right ones. The reason most traders feel anxious, rushed, or emotionally exposed is not because trading is inherently stressful. It's because their behavior is uncontained. Too many decisions, too much ambiguity, too much room for impulse. Calm does not come from predicting better. It comes from narrowing your actions. Today we're going to talk about the only 4 rules you need to trade calmly. Not occasionally, not on good days, but every time you sit down. These rules won't make you rich overnight. They will do something far more important. They will make you stable, and stability is what makes consistency possible. Let's start with the first rule, the one most traders resist the hardest. Only trade when your conditions are obvious, not promising, not interesting, not almost there, obvious. Most trading stress comes from ambiguity. You enter trades that require explanation, trades you need to justify, trades that feel right but don't look clean. Your brain hates ambiguity because ambiguity increases responsibility. When conditions are unclear, you become the deciding factor. And when you are the deciding factor, emotion enters. Calm traders remove interpretation wherever possible. They define conditions so clearly that execution feels mechanical. When the setup appears, there is no debate. When it doesn't, there is no temptation. This does 2 things psychologically. First, it reduces decision fatigue. Second, it reduces self-blame. You're no longer asking, was I smart enough? You're asking, did conditions exist? This separates your identity from the outcome. If you want to trade calmly, stop trading ideas. Trade criteria. Now the second rule, and this one is non-negotiable. Risk must be boring. If your risk excites you, it's too big. Calmness cannot coexist with oversized risk. Your nervous system does not care how confident you are. It responds to exposure. When too much is at stake, the body reacts before the mind can intervene. Heart rate rises. Focus narrows. Impulse increases. You cannot think clearly while defending survival. Professional traders choose risk levels that allow emotional neutrality. A loss should register, but not linger. If a loss stays with you, you're risking too much. If you check the trade obsessively, you're risking too much. If you feel relief instead of acceptance when you exit, you're risking too much. Calm trading requires that losses be absorbable without commentary. This is not about fear, it's about bandwidth. When risk is small enough, your mind stays online. You see clearly. You execute cleanly. You stop when you should. Big risk turns every trade into a referendum on your competence. Small, controlled risk turns trading into a process. If you want calm, choose boredom over excitement. Now, the third rule, the one that creates the most peace. You must know when you are done before you start. Most traders feel restless because there is no ending, no stop point, no boundary, no closure. They keep trading because nothing tells them to stop. Calm traders predefine their exit from the session. This could be a number of trades, a time window, a loss limit, a mental state. The specific rule matters less than the existence of one. Endings create safety. When your brain knows there is a limit, it relaxes. Without limits, every moment feels open-ended, and open-ended environments increase anxiety. This is why casinos have no clocks. Calm traders install clocks. They know when they're finished before the first trade is placed. And when that condition is met, they stop, even if they feel like continuing, especially if they feel like continuing, because the urge to keep going is often the first sign calmness is slipping. Boundaries are not restrictions, they are protection. Now the fourth rule, the quietest but most powerful. Judge yourself only on execution, never on outcome. This rule rewires everything. As long as you judge yourself by results, calmness will be fragile, because outcomes are uncontrollable in the short term. You can do everything right and lose. You can do everything wrong and win. If your emotional state depends on which one happens, you will always be reactive. Calm traders change the scoreboard. A good trade is one that followed the rules. A bad trade is one that didn't. Money becomes feedback, not validation. This removes emotional whiplash. You stop celebrating wins taken poorly. You stop punishing yourself for losses taken correctly. Your nervous system stabilizes because the evaluation criteria are consistent. This is how traders develop emotional resilience. Not by avoiding losses, but by making losses non-threatening to identity. When execution is the metric, calmness follows naturally, because execution is within your control. Now, let's step back. These 4 rules don't make trading easy. They make it simple, and simplicity is calming. Most trading stress is self-inflicted through complexity, overexposure, and vague standards. Calm traders do less. They trade fewer setups, risk less per trade, trade for shorter windows, judge themselves by behavior. This creates a feedback loop. Calm behavior leads to better execution. Better execution builds trust. Trust reinforces calmness. Over time, this compounds. You stop needing emotional management techniques. You don't need to stay calm. Your system does it for you. And here's the most important part. Calm trading is not passive. It is deliberate. It is the result of choosing rules that protect your mind instead of testing it. If you can follow these 4 rules consistently, you won't just trade better, you'll think better. And when thinking improves, results follow, quietly, steadily, without drama. Implementation is where calm either becomes real or stays theoretical. Most traders agree with these rules intellectually, then return to the same behavior because nothing changes structurally. Calmness doesn't come from understanding the rules. It comes from building them into your environment so they're harder to break than to follow. Let's walk through how to implement each rule step by step in a way that survives real market conditions. Start with the first rule. Only trade when conditions are obvious. Implementation begins away from the chart. You cannot define clarity while price is moving. The brain becomes biased the moment there is motion, urgency, or potential reward. So, the work must be done when the market is closed or irrelevant to you. Step 1 is to write down your setup in visual terms, not conceptual ones. Avoid language like strong level, clear trend, or good momentum. These words feel precise, but they aren't. They invite interpretation. Instead, describe what must be present on the chart in a way that 2 different people could agree on without discussion. What time frame does the setup appear on? What must price do before the setup is valid? What must price not do? Where is the entry invalidated? If you can't describe your setup without using judgment words, it's not obvious enough yet. Step 2 is to reduce the number of valid scenarios. Most traders fail here because they want flexibility. They believe flexibility is intelligence. In reality, flexibility under pressure is ambiguity. Limit yourself to 1 primary setup, maybe 2 at most. Anything beyond that reintroduces debate, and debate destroys calm. Step 3 is the hardest part. You must actively practice not trading when conditions are close, but not exact. This is where discipline is built. Every time you skip a nearly there setup, you reinforce your standards. Every time you take one, you weaken them. Calm traders trust their rules because they've proven to themselves that they can wait. Now, let's implement the second rule. Risk must be boring. This is not about choosing a percentage once and forgetting it. It's about calibrating risk to your emotional response. Start by deliberately reducing your risk below what feels reasonable, not forever, just temporarily. Trade at a level where losses register intellectually, but not emotionally, where you don't feel the need to explain or justify them, where you can take 2 or 3 losses in a row without internal tension. This level is usually lower than most traders expect. Stay there longer than feels necessary. Calm is trained through repetition under low threat. Once you notice that losses no longer hijack your thinking, You can gradually scale up, but only to the point where calm remains intact. If anxiety returns, you've gone too far. Your correct risk level is not defined by account size. It's defined by nervous system stability. Another key implementation detail: risk must be fixed and pre-decided. No adjusting based on confidence. No increasing size after a loss. No, this one feels special. The moment risk becomes variable, calm disappears. Fixed risk removes emotional negotiation. Now the third rule: know when you are done before you start. Implementation here is simple, but uncomfortable. You must choose a stopping condition that feels slightly restrictive. If it feels generous, it won't protect you. Examples include a maximum of 1 or 2 trades per session, a fixed trading window, a hard stop after one loss, stopping when focus drops, regardless of results. Pick one, write it down, and most importantly, rehearse stopping. Don't wait for a perfect day to test it. The first few times you stop according to your rule, your mind will protest. It will say you're missing opportunities, that you're wasting potential, that today is different. Ignore it. That voice is not intuition. It's dopamine withdrawal. Every time you stop as planned, you teach your brain that trading has an ending. Over time, this dramatically reduces restlessness and impulsive behavior. Calm traders don't stop because they feel done. They stop because the rule says so. Now, the fourth rule: judge yourself only on execution. This one requires a shift in how you review your trading. Stop asking, how much did I make? Was this a good trade? Start asking, did I follow my rules? Did I execute as planned? Did I stop when I said I would? Create a simple post-session review. No charts, no P&L analysis, just behavior. Answer 3 questions. Did I trade only my setup? Did I respect my risk? Did I respect my stopping rule? That's it. If the answer is yes, the session was successful, regardless of money. If the answer is no, the session needs correction, even if you profited. This rewires what your brain seeks. Instead of chasing profit to feel competent, you begin chasing alignment with your rules. Calmness grows because your self-evaluation becomes stable and fair. Over time, something important happens. You stop needing willpower. The rules stop feeling restrictive and start feeling supportive. You no longer feel like you're fighting yourself to trade well. You feel contained, protected, clear. That's what calm trading actually is. Not emotional suppression, not confidence, not experience, but structure that removes unnecessary decisions. Calm trading is not a personality trait. It's a system outcome. Traders feel anxious and reactive not because markets are stressful, but because their behavior is unstructured. Too many decisions, too much interpretation, and too much risk turn every trade into an emotional event. The solution is not more confidence or better prediction. It's 4 simple rules, implemented deliberately. First, trade only when conditions are obvious. Clarity removes debate, and debate is where emotion enters. Second, keep risk boring. When risk is small enough to preserve emotional neutrality, thinking stays clear and execution improves. Third, know when you're done before you start. Predefined endings reduce restlessness and protect discipline. Fourth, judge yourself only on execution, not outcomes. When behavior becomes the scoreboard, calmness becomes stable. These rules don't make trading exciting. They make it sustainable. When structure replaces impulse, calm follows naturally, and consistency becomes possible.